Feels like we're heading towards 5% on a US 10-year. How does that change the picture for you?
Yeah, it certainly feels like it. I think the important thing to note is I think 5% is not so crazy considering where the macro picture is right now.
Yep.
I think as long as growth is good, equities can deal with that and the economy possibly can deal with that for some time. I think the challenge is always with regards to bond yields, level, speed and source of the increases. I think level-wise, that's a long debate. I think we might argue that, closer to 5% is the new equilibrium we have without the recession around the corner, with a no landing scenario.
Yep.
What the market doesn't like is the speed. I think it's been too fast a move, and it's come at a time where arguably the source has not been linked to growth as much. It's been more linked to policy, where the market is reassessing the kind of new neutral rate, and that is something that equities don't really like right now. And you have to consider that also in the last few days, you've had a few kind of things going on, like Middle East tensions. You're entering earnings season. Earnings information so far has been a bit mixed, you could say, with some of the Magnificent Seven at least being in focus. Yep. So it feels like a bit shaky.
A bit shaky. Can we get through the shakiness? Can we push on to further highs? Is this something that is going to become more problematic for equities? Oh, we've had a very good run. This has been a sensational run for stocks. Yeah. Is it harder to make gains from here, given the headwinds that you've just discussed?
I think you make a very good point here. I think we've had a phenomenal start to the year. We had a phenomenal rally. If you look at positioning and sentiment indicators, they were elevated. And understandably, though, like there was huge momentum, kind of investors were possibly squeezed a bit into the market. So you have a bit of a setback. But stepping back to the fundamentals and the macro, in a broader scheme of things, growth is good and inflation is coming down, and central banks will cut rates. So overall, equities in this type of backdrop should make progress. So we have to be clear on the growth side, which currently is a bad thing, like the retail sales you were mentioning. We are still having a lot of positive news flow that can be supportive for equities. But also important is outside of the US, actually inflation pretty much everywhere is coming down. And I think you mentioned the labor market this morning out of the UK. I think generally the macro picture outside of the US has been weaker. And generally, that eventually should mean there's a bid for the bond market emerging. You should stabilize the yield levels. So growth is good. Yields eventually find the equilibrium, and you will get some cuts. Probably not as many as people were hoping. All of that should be making equities stabilize, and equities can make progress. Are you going to get as strong returns as you had at the beginning of the year? Probably not. There will be some moderation.
Christian, Creedy, talk to us about where the bond market fits into all of this. If there's an expectation of higher yields in the near future, what incentive is there to hop into bonds right now?
I think as a near-term investor, you have to consider how much yields can go up, and that costs you relative to really what the bond market can do for an asset allocation kind of portfolio. And the fact is, if you look at a 300-year history of the US 10-year yield, is a decent history. You could argue from the beginnings of the US, really, the average is actually 4.6, which is more or less where we are. If you take out the 70s, the average yield is 4.4. So you have to ask yourself how much further, especially in the medium term, 10-year yields will go to kind of be a drag on fixed income allocations relative to the benefits you're getting. The benefits are a real yield, which is reasonably attractive. The closer you get to 2.5, I think that's the level we've been saying that it's a bit of a speed limit for the bond market to sell off further. So 2.5% real yield, that's actually slightly above average, and it's a pretty decent yield in the world we live in. And on top of that, you have to consider that there will be protection value when you need it. I think we have several indications this year that, for example, when you have Middle East tensions, geopolitical shocks, but also selective growth shocks, that the bond market will buffer in these scenarios. Doesn't feel like you need that right now with the data, but that might change in a few months. So I think the longer your investment horizon gets, the more you want to think about the bond sell-off right now as an opportunity to maybe get to the type of bond allocations you want to be in the medium term.